All right, let's get right into it. If you invest in tech, you know there's this constant push and pull, right? It's that classic dilemma. Do you chase the explosive rocket ship growth or do you crave that steady, predictable income? We're going to break that whole thing down today.
I saw one analyst describe JPQ like this, and it just clicked. It's the perfect way to think about it. It's not some totally different thing, it's an evolution. It's like the classic tech growth strategy grew up, it's a little more mature now, and it's figured out how to pay the bills along the way. And for good reason. This is where the world-changing companies live. And for the longest time, the main way you'd get in on that action was through the QQQ ETF. It's just a pure, straight shot of innovation. It's fast, it's exciting, and wow, has it created some incredible wealth.
But that's the million-dollar question, isn't it? What if you still believe in all that? AI, the cloud, all of it. But you're just kind of tired of the wild swings, the gut-wrenching drops that make you question everything. Is there a way to get the upside of tech, but also get a paycheck?
So let's properly meet our two contenders. They're both completely obsessed with the Nasdaq 100, but boy, do they have two very different ways of showing it. And this is where it gets really interesting for you as an investor.
This lays out their entire life philosophies. On one side, you have QQQ. It has one job and one job only. Make your investment go up. That's it, pure capital appreciation. But then you have JEPQ over here, playing a different game. It has a dual mission. Yeah, it wants growth, but it's just as focused on cutting you a check every single month and making the journey a whole lot smoother. And you can see that trade-off right here in the numbers. Looking at the data from 2022 to 2025, yeah, QQQ absolutely crushed it on annualized return, no question. But look closer. JEPQ offered this massive dividend yield. We're talking around 10%, while QQQ was down below 1%. And the kicker? It did it with way less volatility. You're basically swapping some horsepower for a much calmer income-producing ride.
Okay, so how in the world does JPQ generate that kind of income? It's not magic, I promise. It's a strategy that big-time investors have used forever, just conveniently packaged up for the rest of us. So let's pop the hood on this thing.
It's really just a four-step process. First, just like QQQ, it owns the big Nasdaq stocks. Simple enough. Second, and this is the secret sauce, it sells what are called call options on those stocks. Just think of it like selling someone the right, but not the obligation, to buy your stocks from you later at a higher price. Third, for selling that right, JPQ gets paid a fee, which is called a premium. And finally, it scoops up all those fees and pays them out to you, the investor, as a monthly dividend.
So the easiest way to think about this is that JPQ acts like a landlord for its stocks. It owns the property, the shares of Apple, Microsoft, Nvidia, and it collects monthly rent from the market in the form of those option premiums. That's how it can make money even if the market is just treading water. All right, let's get back to the charts because when you look at the performance and the payouts side by side, they tell two totally different stories about what it's like to own these funds. It's about way more than just the final number.
You look at this number for QQQ and it's a beast. A total return between 14 and 16% annually during this period. That is a powerful growth engine, just firing on all cylinders, capturing all that amazing tech upside. And just looking at that, you'd think, okay, case closed. QQQ is the winner, end of story. But hold on, not so fast. That's only looking at one half of the picture. The story of risk and income tells a very, very different tale.
See, JEPQ's real superpower might not even be on a performance chart. It's what it does for you, the human being who has to live through the market's craziness. That consistent monthly income acts like a kind of psychological armor. It makes it so much easier to stay invested when things get choppy. And this stability really comes from three things. First, the whole strategy is just built to be less volatile. Second, that reliable monthly paycheck gives you a positive return, even if stock prices are having a bad month. And third, all that leads to smaller drawdowns, meaning it just doesn't fall as hard during a correction. It's a lot easier not to panic sell at the bottom when you know another check is coming in 30 days. Now this is the really cool part. The engine that creates JPQ's income, those option premiums, it actually gets stronger when the market gets more scared. When volatility spikes, the premiums go up. So right when the market is in full-on panic mode, JPQ's ability to generate income can actually increase. It literally gets paid more when everyone else is freaking out. So after all that, what does this mean for you? Well, the decision really comes down to who you are as an investor, your goals, how much time you have, and honestly, your stomach for risk. Let's figure out which profile fits you. So, you're probably a QQQ person if you're earlier on in your investing life. You've got decades ahead of you, so you're not sweating the big swings because you know you have time to recover. Your absolute number one goal is to capture every single drop of growth from those tech giants. You want the uncapped upside.
On the flip side, you might be leaning toward JEPQ if your priorities are shifting a bit. Maybe you're getting closer to retirement, or you're already there, and you need your portfolio to start paying you back. Or hey, maybe you're just someone who values a smoother ride and wants to sleep a little better at night, all while staying invested in the future. But here's the thing, and this is really important. This doesn't have to be an either-or decision. For a lot of people, the best answer is both. You can absolutely use QQQ as your main growth engine and then blend in JEPQ as your income and stability machine. They can work together beautifully in the same portfolio. And there's actually a nerdy finance metric for this. It's called the Sharpe ratio. All it does is measure how much return you're getting for the amount of risk you're taking. And what the data often shows is that while QQQ might have the higher raw return, JEPQ often delivers a better risk-adjusted return. Put simply, you're getting more bang for your buck with fewer headaches. I just think this quote sums it all up perfectly. For so long, we were taught that investing in tech meant you had to give up income. You just had to accept it. But that's just not true anymore. This shows you can be all in on the future of innovation and still collect a steady rent check every month. So I'll just leave you with that question. In a world that feels more volatile than ever, maybe it's time to think about putting your tech stocks to work in a totally new way. Instead of just hoping they go up, maybe it's time to start demanding they pay you a little rent.